All right, so we're diving deep into finance today with these excerpts you sent me from How to Read the Financial Pages by Michael Brett.
The good one.
Yeah, and looks like we've got a pretty big stack here.
We do.
Covering everything from stock markets and bonds to even the infamous Lloyd's insurance market.
Oh, yeah, that'll be interesting.
So our mission for this deep dive is to really extract the most important nuggets of knowledge from this book and help you understand how financial markets really work without getting too bogged down in the jargon.
Love it.
One of the first things that really struck me as I started going through these excerpts was Brett's emphasis on how interconnected everything is. No economy is an island, he says.
Right.
And he really highlights this point with currency speculators and their impact on events like Britain's exit from the European exchange rate mechanism and even the Asian financial crisis back in 1997.
It's true when you think about it.
Right.
Speculators, I mean, they didn't necessarily cause these crises, but they definitely amplified existing weaknesses.
Yeah.
You know, it's like a domino effect. One event kind of triggers another. And the consequences can really ripple across borders. And this idea of interconnectedness is still so crucial today.
Right.
You know, someone might think, oh, well, I'm just managing my own budget.
Right.
But actually, global trends, you know, in currencies and currency values can impact everything from the price of that, you know, imported coffee you might love or to the interest rates on your mortgage.
Yeah, wow. It's like the butterfly effect, but with money.
Totally.
It really makes you realize that even these seemingly distant events can have a real impact on your wallet.
Absolutely.
And speaking of things that can impact your wallet.
Oh, yeah.
Brett also dives into the internet as both a gold mine and a minefield for investors.
Oh, absolutely.
On the one hand, you've got this wealth of information at your fingertips.
So much information.
But then on the other hand, there's also a ton of misleading tips.
Oh, totally.
And those get-rich-quick schemes lurking out there.
Ugh, yeah. Those are the worst.
Yeah, for sure.
And remember that old saying?
What's that?
Where there's a tip, there's a tap?
Oh, yeah.
You know, someone offering you some so-called insider information might have ulterior motives. They could be trying to offload their own risky investments or even manipulate the market. Brett actually specifically warns against day trading, which, let's be honest, is often just a fancy way of saying gambling. It might seem tempting to chase those short-term price swings, but the reality is you're probably more likely to lose your shirt than make a fortune.
Yeah, you're probably right about that.
Yeah.
If something sounds too good to be true, it probably is.
Probably is.
Okay, let's shift gears a little bit here.
Go.
Brett takes us on a little tour of the UK's financial landscape, and he walks us through some key moments in history, from New Labour's economic policies to the introduction of the euro. One thing that really stood out to me was the phasing out of the advanced corporation tax system.
Yes.
It sounds very technical.
It is.
But he kind of hints that it had a pretty big impact.
It did. It did, especially for anyone interested in pensions.
Oh, really?
Yeah. Essentially, what happened is that when they phased out that system, the UK government kind of increased the tax burden on companies.
Okay.
And this had this like ripple effect on pension funds, you know, reducing the overall return on their investments.
Oh, wow.
So the takeaway here is that even these like seemingly technical changes in tax policy can actually have a very real impact on your long-term financial well-being.
So it pays to stay informed.
It does.
Even when it comes to the, you know, the nitty-gritty details of tax policy.
Yeah, for sure.
All right. So Brett keeps coming back to this idea of interconnectedness, particularly when it comes to financial markets. And he says that the linking factor is the cost of money.
Right.
Or, I don't know, it's interest rates. How does that tie everything together?
Well, think about it this way.
Okay.
Interest rates represent the cost of borrowing money.
Right.
So when interest rates are low, borrowing becomes cheaper, which can stimulate economic activity.
Okay.
But then when interest rates rise, borrowing becomes more expensive, which can slow things down.
Okay.
And these fluctuations in interest rates, they ripple across all sorts of financial markets, influencing everything from mortgage rates to the cost of issuing corporate bonds.
It's like a spider web.
It is.
You tug on one strand and the whole thing vibrates.
Totally.
Okay, let's zoom in on something that I think can be pretty daunting for a lot of people. Share prices. Brett explains that share prices reflect the balance between buyers and sellers. But what does that actually mean in practice?
Okay, so imagine like in a bustling marketplace where people are constantly, buying and selling goods. If more people want to buy a particular item than sell it, the price goes up. And if more people want to sell than buy, the price goes down. It's basic supply and demand. But this same principle actually applies to share prices.
Gotcha.
So when more investors want to buy shares in a company and sell them, the price of those shares rises. And conversely, if more investors want to sell than buy, the price falls.
Right. So it's this constant tug of war between optimism and pessimism reflected in the ever-changing share prices.
Absolutely.
But how does the cost of money then factor into all of this?
Well, interest rates actually play a significant role in shaping investor behavior. So when interest rates are low, investors might be more willing to take on risk and invest in the stock market, hoping for those higher returns. But when interest rates rise, investors might shift their focus to less risky investments, like bonds, which offer more predictable returns. So this shift in investor sentiment can impact the demand for shares and consequently their prices.
So it's like a giant game of musical chairs.
Totally.
With investors constantly adjusting their positions based on the tune played by interest rates.
I like that analogy.
Okay, I'm ready to level up here.
Okay.
Let's talk about corporate finance.
All right.
So Brett uses a fictional company called John Smith & Co. to break down the anatomy of a balance sheet. He dives into assets, liabilities, equity, and this concept called gearing. Can you help us unpack all of this?
Sure. So a balance sheet is basically like a snapshot of a company's financial health at a specific point in time. On one side, you have assets, which is what the company owns, like cash in the bank, buildings, or even patents. And on the other side, you have liabilities, which is what the company owes to others, like loans or unpaid bills.
So far, so good.
So far, so good.
But what about equity?
Equity represents the owner's stake in the company. It's the difference between the company's assets and its liabilities. So think of it like this. If the company sold all of its assets and paid off all its debts, whatever is left over belongs to the owners or the shareholders.
I think I'm starting to see the bigger picture here. Now, what about this gearing concept? It sounds a little bit intense.
It's simpler than it sounds. Gearing essentially refers to how much debt a company uses to finance its operations. So a high-geared company relies heavily on borrowed money, whereas a low-geared company uses more equity. Imagine gearing like a seesaw. A company with high gearing is like a seesaw that's heavily tilted to one side, making it less stable. So a small change in market conditions or profits could have a big impact on its ability to stay balanced.
That's a great analogy. So a low-geared company with more equity would be like a more evenly balanced seesaw and therefore more resilient to shocks.
Exactly.
This makes me wonder about the different ways that companies can actually raise money. Brett mentions equity finance and debt finance. What are the pros and cons of each?
Okay, well, with equity finance, a company raises money by issuing shares, giving investors a piece of ownership in exchange for their capital. The good news is that the company doesn't have to repay this money, like a loan. But the downside is that the company's profits are now shared among a larger pool of owners, which dilutes the existing shareholders' stake.
Makes sense. And what about debt finance?
Okay, so debt finance involves borrowing money, typically through loans or by issuing bonds. The advantage is that the company doesn't have to give up ownership. However, the company is obligated to repay that borrowed money with interest, which can eat into profits. And if the company struggles to repay its debts, it could face serious consequences, even bankruptcy.
So it's a delicate balancing act for companies.
It is.
Choosing the right mix of equity and debt financing to achieve their goals. Speaking of goals, let's talk about what I think everyone's really interested in when it comes to this world.
What's that?
Investing.
Investing.
Brett takes us beyond the hype and really dives into the different types of shares that investors can buy, including ordinary shares, preference shares, and even something called convertible loan stock. What should we know about these different options?
Well, each type of share offers unique characteristics and potential benefits.
Okay.
Ordinary shares are probably the most common, and they give shareholders voting rights in company decisions, and the potential to receive dividends, which are a share of the company's profits.
Okay.
Preference shares, on the other hand, usually offer a fixed dividend, which provides a more predictable income stream.
Okay.
But typically, they don't come with voting rights.
Right. So a little bit of a trade-off there.
Yeah, a bit of a trade-off.
Okay. And what about convertible loan stock?
Convertible loan stock. It's kind of like a hybrid of both worlds.
Okay.
It's initially a loan to the company, paying a fixed interest rate.
Okay.
But it has this exciting twist.
Oh.
Where it can be converted into ordinary shares at a predetermined point in time.
Interesting.
So it gives investors kind of the potential upside of owning shares if the company does well, while also providing the security of a fixed income investment initially.
Okay, that sounds pretty interesting. Brett also emphasizes the importance of understanding equity earnings and what influences those dividend payouts.
Absolutely.
Can you shed some light on that for us?
Sure. So equity earnings represent the profit that's attributable to the company's shareholders after all expenses and taxes are paid.
Right.
So think of it as the company's net income,
the
real bottom line for the owners.
Okay.
The company then decides how much of this profit to distribute as dividends to shareholders and how much to retain for future growth and investments.
So as an investor, I should be paying attention not only to the company's overall profit, but also to their dividend policy.
Absolutely.
Because that directly impacts my potential returns.
Yeah.
Okay, ready to step onto the trading floor.
I think so.
Let's talk about the stock market itself. Brett gives us a tour of the London Stock Exchange.
Sure.
And he introduces some key players like brokers and market makers. He even explains the impact of Big Bang deregulation, which sounds like a pretty pivotal moment.
It was Big Bang in 1986. Was this dramatic shakeup of the London Stock Exchange. It removed a lot of regulations. Which led to increased competition and the introduction of electronic trading systems.
Wow.
So, you know, before Big Bang, brokers would physically gather on the trading floor, shouting and waving paper orders.
Oh, wow.
But afterward, trading moved to computer screens, which made the market faster, more efficient, and accessible to a much wider range of investors.
So that's a pretty big transformation.
Yeah, a huge transformation.
Brett also mentions this thing called the CREST system.
Okay.
Which sounds very high-tech.
It is. It's an electronic share settlement system that really revolutionized how shares are traded and transferred. Remember those old paper share certificates? Well, with CREST, everything is handled electronically. Eliminating the need for those physical certificates and making the process so much faster and more efficient.
That makes sense.
It's like the difference between sending a letter and sending an email. Speed and convenience win.
So no more waiting for those certificates to arrive in the mail.
Exactly.
All right, before we get completely lost in the whirlwind of the stock market, let's take a step back and talk about how to actually navigate this complex world. Brett offers some valuable advice on avoiding pitfalls and understanding the factors that influence share prices. He mentions both fundamental and technical influences. What are those?
So when analyzing a company's share price, investors often consider both fundamental and technical factors. Fundamental analysis focuses on the company's underlying business performance. So things like their revenue profits, assets, and debt.
So it's about understanding the company's intrinsic value.
Yeah, you could say that. It's like looking under the hood. Understand what's driving the engine.
Gotcha. What about technical analysis then?
Okay, so technical analysis focuses on historical price patterns and trading volume and uses charts and indicators to try to predict future price movements. So it's more about studying the market's behavior and sentiment, just trying to anticipate where the crowd is heading.
So it's a little bit of art and science combined.
Yeah, you could say that.
But Brett also reminds us about the inherent volatility of the stock market. And he shares the story of the 1987 crash.
Yes.
What lessons can we learn from that event?
The 1987 crash, sometimes called Black Monday, was a real stark reminder that stock markets can be unpredictable and prone to these sudden dramatic swings. It was a combination of factors, including program trading, which was kind of an early form of algorithmic trading, market psychology, and some economic concerns that kind of created this perfect storm, leading to a massive sell-off and this like record-breaking one-day drop in share prices.
It sounds like a real-life roller coaster ride.
It was.
What key takeaways can we glean from this historical event?
I think it highlights the importance of understanding risk and not getting caught up in speculative bubbles. It also emphasizes the interconnected nature of global markets. Because that crash quickly spread across borders. So it's a reminder that even in seemingly prosperous times, markets can turn very quickly. And diversification and risk management are so essential for long-term success.
It's definitely a cautionary tale about the dangers of overconfidence and the need to stay grounded in reality. Okay, ready to explore something a little bit more exciting. Let's dive into the world of new issues.
New issues,
Those initial public offerings that generate so much buzz and excitement. Brett helps us demystify the process, including concepts like offers for sale and rights issues. So what are these all about?
So new issues, or IPOs, are a way for companies to raise capital by selling shares to the public for the first time. An offer for sale is a common type of IPO, where a company sells a portion of its shares directly to the public through an investment bank.
So it's like a grand opening sale.
It is.
Attracting new customers and generating excitement.
Exactly.
And what about rights issues?
So rights issues are a way for companies to raise additional capital from their existing shareholders. So the company offers existing shareholders the opportunity to purchase additional shares at a discounted price, proportionate to their current holdings.
So it's like giving loyal customers a special offer. Rewarding their loyalty and giving them a chance to increase their stake.
Exactly.
Brett also mentions these terms, underwriting and staging. Can you break those down for us?
Sure. So underwriting is kind of like an insurance policy for the company issuing the shares. Investment banks agree to purchase any unsold shares at a predetermined price. This ensures that the company raises the desired capital, even if public demand is lower than expected.
So it's a way to minimize the risk for the company going public.
Exactly.
What about staging then?
Staging is a practice where investors apply for shares in an IPO with the intention of selling them immediately for a quick profit as soon as trading begins. So they're hoping to capitalize on that initial hype and price momentum, but it can be a risky strategy because there's no guarantee that the share price will actually go up as soon as trading starts.
So it's a little bit like flipping houses, trying to make a quick profit by timing the market just right.
Absolutely.
Now let's move on to those corporate actions that can impact shareholders in different ways. Brett dives into things like scrip issues, share buybacks, and the complexities of returning cash to shareholders. So let's start with those corporate actions.
So corporate actions are events initiated by a company that can affect the number of shares outstanding, the share price, or the distribution of profits to shareholders. A scrip issue, also known as a bonus issue, is when a company gives existing shareholders additional shares for free. Imagine it like receiving a bonus gift with a purchase. The value of your overall holdings remains the same, but you now have more shares.
So it's like slicing the same pie into more pieces?
Exactly.
What about share buybacks?
All right, so a share buyback is when a company repurchases its own shares from the market. This reduces the number of outstanding shares, which can then increase the value of the remaining shares. Think of it like consolidating your wardrobe. You're getting rid of some items, but the remaining pieces become more valuable.
I like that. I'm starting to see how these actions can impact a shareholder's stake.
Yeah.
But Brett hints at some complexities involved in returning cash to shareholders, typically through dividends.
Yes.
What are those complexities?
While returning cash to shareholders might seem straightforward, companies face several considerations.
Okay.
They need to balance rewarding shareholders with retaining earnings for future growth and investments.
Okay.
They also need to navigate the tax implications because dividends are taxed differently than capital gains.
Okay.
It's kind of like deciding how much of your paycheck to spend and how much to save.
Yeah.
You want to enjoy the fruits of your labor, but also secure your future.
It's a delicate balancing act.
It is.
Between short-term rewards and long-term sustainability.
Absolutely.
Okay, I think we're ready for the big leagues now.
Okay.
The world of takeovers.
Takeovers.
Brett pulls back the curtain on these high-stakes battles, exploring the motivations, the strategies, and the consequences for everyone involved.
They can be quite dramatic, filled with intrigue, power plays, and battles for control.
Okay.
Companies engage in mergers and acquisitions for various reasons, including expanding market share, gaining access to new technologies or resources, or sometimes simply eliminating competition. It's kind of like a game of chess, with each move carefully calculated to gain an advantage.
It sounds like a high-stakes game of strategy and risk.
It is.
And Brett even shares this captivating story about the Guinness Distillers takeover battle.
Yes, that's a classic example of a hostile takeover where things got pretty heated.
Okay.
So Guinness, the famous Irish brewer, made a bid to take over Distillers, which was a Scottish whiskey producer.
Okay.
And the battle involved these complex maneuvers, competing bids, and even allegations of insider trading.
It's like a real-life corporate thriller filled with suspense and drama.
Oh, for sure.
All right, after all that excitement, I'm ready for something a bit more stable. Let's talk about bonds.
Bonds, okay.
So Brett explains the characteristics of government bonds, also known as gilts in the UK, and company bonds, emphasizing their role in raising capital and how interest rates actually impact their prices. So can you give us a little bit of a bond breakdown?
Sure. So bonds are essentially loans that investors make to governments or companies.
Right.
When you buy a bond, you're lending money to the issuer for a specific period.
Okay.
And in return, you receive these regular interest payments and the principal amount back at maturity.
Okay.
Government bonds are generally considered very safe investments.
Right.
Because they're backed by the government's ability to tax.
Yeah.
Company bonds carry slightly more risk as the company's financial health determines its ability to repay that debt.
So it's a bit like being the bank, lending money and earning interest.
Yeah.
But Brett mentions that interest rates play a key role in determining bond prices.
They do.
How does that work?
Okay, so imagine you buy a bond today that pays a 5% interest rate.
Okay.
If interest rates in the market then rise to 6%, your bond paying a lower interest rate becomes less attractive.
Okay.
So to sell it, you might have to offer it at a discount, lowering the price to compensate for that lower interest rate.
Gotcha.
Conversely, if interest rates fall to 4%,
yeah,
your bond paying a higher interest rate becomes more valuable, and you could potentially sell it at a premium.
So bond prices move in the opposite direction of interest rates.
They do.
A key concept to remember.
Very important.
Brett also walks us through this calculation of redemption yields, which can seem a bit daunting.
Yeah, it can. Host, speaker.
Welcome back. I'm ready to dive into the next layer of this financial world. We're about to explore the whirlwind world of foreign exchange, or Forex as Brett calls it, where currencies are traded 24/7. I have to admit, this always seemed a bit like a black box to me, filled with cryptic charts and flashing numbers. Brett describes it as a currency carousel, which paints a much more vivid picture.
It is a bit of a whirlwind, but understanding the basics can really demystify it quite a bit. At its core, the Forex market is simply where different currencies are bought and sold, determining their values relative to each other. Think of it like a giant global marketplace. But instead of trading goods, the products being traded are currencies like dollars, euros, yen, and pounds.
Okay, I can picture that. But what actually drives those currency values up and down? Brett mentions factors like interest rate differentials and central bank interventions. How do those actually impact the exchange rates?
Okay, let's start with interest rates. Imagine you're an investor looking for the best return on your money. You see that one country offers a higher interest rate on its bonds than another. Naturally, you're more inclined to invest in that country to earn that higher return. But to do that, you need to exchange your currency for that country's currency, which increases the demand for it and drives up its value.
So it's like a popularity contest for currencies, with the one offering the best deal, attracting more investors and seeing its value rise. What about those central bank interventions? How do they influence exchange rates?
Central banks, they are powerful players in the forex market. They can intervene by buying or selling their own currency in the market to try to influence its value. For example, if a central bank wants to weaken its currency to make its exports more competitive, they might sell their currency and buy foreign currencies, increasing the supply of their currency in the market and potentially lowering its value.
So it's a bit like a tug of war, with central banks trying to steer their currencies in a desired direction. But how much power do they actually have? Can they completely control those exchange rates?
Well, their influence isn't unlimited. While they can intervene in the market, they're often fighting against these strong market forces that are driven by global economic trends, investor sentiment, and even political events. If a central bank tries to swim against a really strong current, they might find themselves depleting their foreign exchange reserves with very little lasting impact.
It's a good reminder that even the most powerful institutions can't completely control the ebb and flow of these global financial markets. Now, Brett also mentions different exchange rate regimes, from fixed to floating, and even something called managed floats. What are the differences between these?
Okay, so think of a fixed exchange rate as a country pegging its currency to another currency or a basket of currencies at a predetermined rate. It's like anchoring your boat to a specific point. The benefit is stability and predictability, which can be good for trade and investment. However, maintaining a fixed exchange rate can be challenging, especially during times of economic turmoil, because it might require significant interventions by the central bank.
So it's a bit like trying to hold a beach ball underwater. It takes constant effort. What about those floating exchange rates?
A floating exchange rate allows the currency's value to fluctuate freely based on market forces. It's like letting your boat just drift with the current. The advantage is that it allows the currency to adjust naturally to changing economic conditions, but the downside is that it can lead to volatility, which can make planning and forecasting more challenging.
So it's a trade-off between stability and flexibility. What about managed floats? They sound like a hybrid of the two.
You're right, a managed float is somewhere in between. The currency is allowed to float, but the central bank might intervene to smooth out excessive volatility or nudge the exchange rate in a desired direction. Think of it as gently steering your boat while still allowing it to move with the current.
Okay, that analogy really helps. Speaking of currencies, let's talk about the euro. Brett traces its history from concept to implementation, highlighting both the challenges and the benefits of a single currency for multiple countries. That's a pretty remarkable experiment, isn't it?
It is. The euro was a bold vision, creating a single currency for this diverse group of European countries with different economic conditions, policies, and even cultures. The idea was to promote economic integration, reduce those transaction costs, and simplify trade and travel within the Eurozone.
And it certainly achieves some of those goals. It's much easier to travel between those Eurozone countries without having to exchange currencies. But what about the challenges? Brett hints at some downsides to having a single currency.
One of the main challenges is that countries within the Eurozone lose control over their own monetary policy. They can no longer adjust interest rates or their exchange rate to respond to specific economic conditions within their own borders. This can be problematic, especially if one country is experiencing an economic boom while another is struggling with a recession.
So it's like being in a car with multiple drivers but only one steering wheel. What about the UK's decision to stay out of the Eurozone? What were the key considerations behind that?
The debate over whether the UK should join the euro was intense and divisive. Those in favor, they argue that it would boost trade, reduce costs, and promote economic stability. Those against argued that it would limit the UK's economic sovereignty, potentially expose the UK to economic shocks originating in other Eurozone countries, and that the UK economy just wasn't sufficiently aligned with the rest of the Eurozone to make it work.
It was clearly a complex decision with potential benefits and risks to weigh. Ultimately, the UK decided to keep the pound, maintaining its control over monetary policy. Okay, time to venture into another intriguing area. Euro markets. Brett describes them as offshore financial centers, highlighting London's role as a major hub. What exactly are euro markets and why are they important?
Think of Euro markets as this parallel financial system that operates outside the traditional regulations and constraints of domestic markets. They emerged in the post-World War II era, partly driven by restrictions on capital flows and interest rate regulations in many countries. So they provided a way for companies and institutions to access capital and borrow or lend in various currencies beyond the reach of those regulations.
So it's a bit like a financial free zone operating under its own rules. But why London? What made it a center for Euro market activity?
Well, London has this long history as a global financial center with a well-established financial infrastructure expertise and a relatively flexible regulatory environment. All of this made it a natural hub for that Euro market activity, attracting banks, investors, and borrowers from around the world.
One of the key instruments traded in the Euro markets is the Eurobond, right? What exactly is a Eurobond and how is it different from a regular bond?
A Eurobond is a bond issued in a currency other than the currency of the country where it is issued. So, for example, a U.S.-based company might issue a Eurobond that's denominated in Japanese yen. The key distinction is that Eurobonds are typically issued and traded outside the regulatory jurisdiction of any single country.
So they're a bit like global bonds transcending national borders. Why would a company choose to issue a Eurobond?
Well, Eurobonds can offer several advantages. They often provide access to a broader pool of international investors, which can potentially lower borrowing costs. They also offer flexibility in terms of currency denomination, maturity, and other features.
It sounds like a way to tap into this global pool of capital, offering benefits for both borrowers and lenders. Brett also mentions Euro commercial paper, which seems like a shorter-term version of the Eurobond.
You're right. Euro commercial paper is a type of unsecured debt that's issued by corporations to meet those short-term financing needs, typically for periods less than a year. Like Eurobonds, it's issued and traded outside the regulatory jurisdiction of any single country, offering similar advantages in terms of access to capital and flexibility.
Okay, I'm starting to see the patterns here. Euro markets offer this global platform for borrowing and lending with instruments like Eurobonds and Euro commercial paper facilitating these transactions. Now let's tackle something that can seem particularly daunting, financial derivatives. Brett asks the question, managing risk or gambling, which I think gets right to the heart of the debate surrounding them.
Derivatives are financial instruments whose value is derived from an underlying asset, like a stock, a bond, a commodity, or even a currency. They can be incredibly powerful tools, but they can also be incredibly risky depending on how they're used.
Brett demystifies the world of options, futures, and swaps, explaining how they can be used to hedge risk, but also for speculation. Can you give us some examples of how these different types of derivatives actually work in practice?
Let's start with futures. A futures contract is an agreement to buy or sell an asset at a predetermined price at a specific date in the future. So imagine a farmer who's worried about the price of corn falling before he can harvest his crop. He could enter into a futures contract to sell his corn at that predetermined price, effectively locking in that price and protecting himself from potential losses if the market price drops.
So it's a way to manage risk and create certainty in a world that's inherently uncertain. But how can those same instruments be used for speculation?
Well, imagine an investor who believes that the price of corn is going to rise. She could buy a futures contract, betting that she can sell it later for a profit when the price goes up. The key difference here is that she doesn't actually have any corn to sell. She's simply speculating on that price movement, hoping to profit from her prediction.
So the same instrument can be used for different purposes depending on the investor's goals and their risk appetite. What about options? Brett describes them as having a right but not an obligation to buy or sell. How does that work?
Options are kind of like having a rain check for an asset. A call option gives you the right but not the obligation to buy an asset at a specific price called the strike price, on or before a specific date. A put option gives you the right but not the obligation to sell an asset at the strike price on or before a specific date.
So it's like having the option to buy or sell at that predetermined price, but you're not obligated to do so. You can just walk away if the market moves against you. What are the benefits of using options?
Options can be used for a variety of purposes, including hedging and speculation. For example, if you own shares in a company and are worried about the price dropping, you could buy a put option, giving you the right to sell those shares at a specific price, limiting your potential losses. Or if you believe the price of a stock is going to rise, you could buy a call option, giving you the potential to buy that stock at a lower price and profit from the increase.
So options provide flexibility and leverage, allowing investors to manage risk or potentially amplify returns. What about swaps? Brett mentions them as agreements to exchange cash flows. What does that mean in practice?
Swaps are agreements between two parties to exchange cash flows based on different financial instruments. For example, a company with a fixed-rate loan might enter into an interest rate swap to convert it into a floating-rate loan, or vice versa. This can be beneficial if they believe interest rates are going to move in a particular direction and they want to manage their interest rate risk.
It sounds like swaps allow companies to tailor their financial arrangements to their specific needs and expectations. But as Brett points out, derivatives can be complex and carry significant risks, especially if used for speculation without a full understanding of their potential downsides.
Absolutely. It's crucial to remember that derivatives are powerful tools that can magnify both gains and losses. While they can be used very effectively for risk management, they can also be incredibly risky if they're used for speculation without a really deep understanding of their complexities.
Okay, I'm starting to get a better grasp of the world of derivatives. Let's shift gears again and dive into a realm that's really steeped in history and tradition insurance. Brett takes us on this fascinating journey through the insurance market, focusing on the unique syndicate structure of Lloyd's of London. I've always been curious about Lloyd's. It seems like an enigmatic institution shrouded in mystery and folklore.
Lloyd's of London is truly a unique institution. Unlike those traditional insurance companies, it's a marketplace where individuals and groups known as syndicates come together to underwrite insurance policies. It's been around for centuries, evolving from its origins in this 17th century coffee house that was frequented by ship owners and merchants who were seeking to insure their cargo.
So it's like this gathering of risk takers pooling their resources to share the burden of potential losses. Brett mentions that Lloyd's faced its share of scandals and challenges over the years. What were some of the key events that shaped its evolution?
Lloyd's has a colorful and sometimes turbulent history. One of the most significant challenges involved asbestos-related claims, which emerged in the late 20th century. Asbestos, once widely used as a fire-resistant material, turned out to be highly carcinogenic, leading to this wave of lawsuits against companies that had used it. Many Lloyd's syndicates had insured these companies, resulting in massive losses that really threatened the stability of the entire market.
Wow, that sounds like a real crisis. How did Lloyd's respond?
Well, Lloyd's underwent significant restructuring and reforms to address that asbestos crisis. They introduced stricter underwriting standards, increased capital requirements, and created this new entity called Equitas to manage and run off those historic asbestos liabilities. This allowed the market to move forward with a clean slate.
It sounds like they learned some valuable lessons about risk management and the need to adapt to changing circumstances. Brett also explains the concept of reinsurance, which seems like a crucial part of the insurance industry. How does reinsurance work and why is it important?
Reinsurance is essentially insurance for insurance companies. They use it to spread risk and protect themselves from those potentially catastrophic losses. Think of it like this. If an insurance company insures a large building against fire, they might reinsure a portion of that risk with another reinsurer. This way, if the building does burn down, the original insurer doesn't have to bear the entire cost of the claim.
So it's a way to create a safety net, ensuring that even in the face of major losses, the insurance industry can remain solvent and continue to provide protection. Okay, I think we're ready to explore another type of investment, commercial property. Brett describes it as a cyclical beast, highlighting the ups and downs of property values and the factors that drive those cycles.
Commercial property, which includes things like office buildings, retail space, and industrial warehouses, can be a fascinating asset class. It can offer both income from rents and potential capital appreciation, meaning the value of the property itself can increase over time. However, it's also influenced by a variety of factors, including interest rates, economic growth, demographic trends, and even government policies.
Brett talks about concepts like rent reviews, leasebacks, and the various financing mechanisms involved. What are some of the key things to consider when investing in commercial property?
Okay, so rent reviews are these periodic adjustments to the rent paid by tenants, typically based on market conditions. If the market is strong and demand for space is, high rents might go up. If the market weakens, rents might stagnate or even fall. Leasebacks are arrangements where a property owner sells a property and simultaneously leases it back from the buyer. This can be a way for companies to free up capital that's tied up in real estate while still maintaining use of the property.
And what about financing? How do investors typically finance commercial property purchases?
Financing commercial property can involve traditional mortgages, partnerships with institutional investors, or even more complex structures involving syndicated loans where a group of lenders provide financing. The specific financing mechanism often depends on the size and complexity of the project, the investor's risk appetite, and the prevailing market conditions.
Brett also shares some cautionary tales about the 1990s property market crash, reminding us that even seemingly stable investments like real estate can be vulnerable to dramatic swings. What lessons can we learn from that event?
The 1990s property market crash was a stark reminder that no investment is completely immune to those economic cycles and market forces. It was triggered by a confluence of factors, including rising interest rates overbuilding and a slowing economy, leading to a sharp decline in property values and leaving many investors with significant losses.
It's a good reminder that diversification, careful research, and a realistic assessment of risk are crucial for success in any investment, even those that seem as solid as bricks and mortar. Okay, we've covered a lot of ground in the second part of our deep dive. We've explored the intricacies of foreign exchange, the rise of the world of euro markets, the power and peril of derivatives, the history and challenges of the insurance market, and the cyclical nature in commercial property. In the final part, we'll bring it all together, looking at savings and investments for individuals, financial regulation, and some final thoughts on navigating this complex financial landscape. Stay tuned for the grand finale. Welcome back to our deep dive into the world of finance. We've journeyed through global markets, explored the inner workings of companies, and even ventured into the realm of derivatives and insurance. Now let's bring it all home and focus on what matters most to you personally, saving and investing for your future.
Yeah, this is where things get really practical. Brett devotes an entire chapter to exploring the various savings and investment options available to individuals, from the familiar like bank deposits to the more complex like unit trusts and ISAs. It can feel overwhelming with so many choices out there.
Oh, it definitely didn't. I remember feeling completely lost when I first started trying to figure out where to put my money. Brett starts with life insurance policies, including whole life and endowment assurance. Those seem pretty straightforward. You pay premiums, and you or your beneficiaries receive a payout, right?
The insurance part is relatively straightforward. The insurance company assesses the risk of death based on factors like age, health, and lifestyle, and they calculate a premium that you pay regularly. If you pass away during the term of the policy, your beneficiaries receive a payout. However, some life insurance policies also have an investment component, which can make things a bit more complex.
What do you mean by an investment component?
Well, some policies, like endowment assurance, combine life insurance with an investment element. So you pay premiums, part of which goes towards the life insurance coverage, and the rest is invested by the insurance company. The idea is that the investment will grow over time, and at the end of the policy term, you'll receive a payout, even if you haven't passed away.
So it's like a savings plan with a life insurance safety net built in. But Brett points out that there are some risks involved.
Right. The final payout depends on the performance of that investment portion of the policy. If the investments don't perform as well as expected, the final payout might be lower than anticipated. It's important to carefully consider the terms and conditions of these types of policies and understand those potential risks and rewards involved.
It's a good reminder that even seemingly straightforward financial products can have complexities that are really worth exploring. Okay, let's move on to something that's crucial for planning for retirement pensions. Brett delves into both company and individual pension schemes. Can you give us an overview of how those work?
Pensions are designed to provide you with an income stream during your retirement years. Company pension schemes, where your employer contributes to your retirement savings, are a common way to build up a pension pot. Some company pension schemes offer defined benefits, guaranteeing a specific income in retirement based on your salary and your years of service. Others are defined contribution schemes where the final payout depends on the performance of the investments within the pension fund.
So with a defined benefit scheme, pretty much what you'll get in retirement, while a defined contribution scheme has more uncertainty with the potential for higher or lower returns depending on how well those investments perform. What about individual pensions?
Individual pensions, or personal pensions, are schemes that individuals can set up on their own independent of their employer. You make regular contributions, and that money is invested to build up a pot of savings for retirement. The final payout depends on how much you contribute, how long you contribute for, and how well those investments perform.
So there's more control, but also more responsibility for managing those investments. Brett mentions that pensions have faced challenges like the mis-selling scandals and the impact of declining long-term bond yields. Can you explain what he's referring to?
Yeah, the mis-selling scandals involved individuals being advised to switch to personal pensions that weren't suitable for their needs, often resulting in losses. These scandals really eroded trust in the financial industry and highlighted the importance of seeking impartial advice before making significant financial decisions.
It's a reminder that not all financial advisors have your best interests at heart. What about declining bond yields? How do those impact pensions?
Long-term bond yields have been declining for several years, making it more challenging for pension funds to generate the returns they need to meet their obligations. Lower bond yields mean lower interest payments, which can impact the overall growth of pension funds and potentially lead to lower payouts for retirees.
So it's a complex landscape for pensions, and it's important to stay informed about the factors that can impact your retirement savings. Okay, let's shift gears and talk about something a bit more familiar. Mortgages. Brett explains the difference between repayment and endowment mortgages, and I have to admit, those interest rate changes always make me a little nervous.
Mortgages are a major financial commitment, so understanding the different types and the risks involved is crucial. With a repayment mortgage, you gradually pay off both the principal and the interest over the term of the loan, usually 25 years or more. With an endowment mortgage, you pay interest on the loan and make regular contributions to an investment policy that's intended to mature and pay off the loan at the end of the term.
So with an endowment mortgage, you're essentially betting that the investment policy will perform well enough to cover that outstanding loan balance. But as Brett highlights, there's a risk that it might not.
Right, if the investments don't perform as well as expected, you could end up with a shortfall at the end of the mortgage term, meaning you'll still owe money on the loan.
Yeah.
And as you mentioned, fluctuating interest rates can have a big impact on your monthly repayments, especially with variable rate mortgages, where that interest rate can change over time.
It's a lot to consider when choosing the right mortgage. Okay, let's move on to some potentially less stressful investment options. Brett dives into unit trusts and investment trusts, and I remember being completely confused by those terms when I first started learning about investing.
They can seem intimidating at first, but the concept is fairly simple. Unit trusts and investment trusts pool money from multiple investors to create a diversified portfolio of assets, typically stocks and bonds.
Right.
This allows individuals to access a broader range of investments than they might be able to on their own, spreading risk and potentially increasing returns.
So it's like teamwork for investors combining resources to achieve a common goal. What's the difference between a unit trust and an investment trust?
Unit trusts are open-ended, meaning they can issue new units as investors buy in. The price of a unit is calculated based on the net asset value of the underlying investments, which is basically the total value of the assets held in the fund divided by the number of units.
Investment trusts.
Investment trusts are closed-ended, meaning they have a fixed number of shares that are traded on the stock market like any other company's shares. The price of an investment trust's shares is influenced by supply and demand in the market, and it can sometimes trade at a discount or premium to the net asset value of the underlying investments.
So with unit trusts, you buy units directly from the fund manager at a price based on that net asset value, while with investment trusts, you buy shares on the stock market, and the price can fluctuate based on market sentiment. Brett emphasizes the variety of unit trusts and investment trusts available, catering to different investment styles and risk appetites.
That's right. There are funds specializing in specific sectors, geographic regions, or investment strategies. For example, you might find a fund that focuses on technology stocks, emerging markets, or ethical investments. This allows you to tailor your investments to your individual goals and preferences.
It's like choosing a restaurant based on your culinary preferences. Now, before we wrap up our deep dive, Brett dives into a crucial aspect of the financial world regulation. He guides us through the UK's regulatory landscape, focusing on the role of the Financial Services Authority, or FSA.
Regulation is essential to maintain a fair and transparent financial system protecting investors and ensuring the stability of markets. The FSA's role is to oversee the activities of financial institutions, set rules, monitor compliance, and take action against those who break the rules.
It's like having a referee on the playing field, ensuring that everyone plays by the rules. Brett emphasizes the need to strike a balance between regulation and allowing markets to function efficiently.
Regulation is a delicate balancing act. Too much regulation can stifle innovation and make it difficult for businesses to operate, while too little can lead to fraud, abuse, and ultimately a loss of confidence in the system. The FSA's goals include maintaining market confidence, promoting public awareness, protecting consumers, and reducing financial crime.
So it's about creating a framework that encourages responsible behavior while also fostering a dynamic and innovative financial sector. Brett also talks about compensation arrangements, which seem particularly important for individual investors.
Compensation arrangements are designed to protect investors in case a regulated firm fails. The Financial Services Compensation Scheme, for example, provides compensation to eligible investors if a firm is unable to meet its financial obligations. This provides a safety net, ensuring that investors aren't left completely empty-handed in case of a financial institution's collapse.
That's reassuring to know. Brett concludes his book with some insightful tips on how to read between the lines and decipher the often confusing language used in financial reporting and commentary.
The financial world has its own jargon and euphemisms that can sometimes obscure the real meaning. Brett encourages us to think critically, ask questions, and not take everything at face value. He reminds us to be wary of overly optimistic projections, vague language, and those controversial city financiers who might not always have our best interests at heart.
It's a good reminder to stay informed, do your research, and seek out impartial advice when making financial decisions. So after this incredible deep dive, what are the key takeaways for our listener? What does it all mean?
Hopefully you now have a better grasp of the fundamental forces driving financial markets, the different investment options available, and the importance of informed decision-making. Remember, the financial world is vast and constantly evolving, but understanding the basics really empowers you to navigate this landscape with greater confidence and make choices that align with your individual financial goals.
It's been an incredible journey through the world of finance. We've covered everything from the global dance of money to the anatomy of stock markets, the complexities of corporate finance, the power of derivatives, and the crucial role of regulation and investor protection.
And as Michael Brett suggests, don't be afraid to challenge assumptions and read between the lines. The financial world can be complex and sometimes deceptive, but with knowledge, curiosity, and a healthy dose of skepticism, you can make it work for you.
That's a great note to end on. Thanks for joining us on this deep dive. We hope you've learned something new and feel empowered to take control of your financial future. Until next time, happy investing.
Did you get any of that?